Nwanuforo from Asset Intelligence, and thank you for joining us for this market update. I'm joined today by Ritu Vohora, investment specialist at T. Rowe Price, an investment firm we work with closely. Now, before we talk a bit about where we're going to go, I just wanted to cover where we've been. So for the past 2 years, investment returns have been largely very positive, and particularly from the US. So for people who don't know, one of the things that sets the Asset Intelligence portfolios apart is that we don't have a home bias. So that means we have more in the US where returns have been very strong. Could you tell us a little bit about why returns from the US have been so strong the past couple of years?
Yeah, that's a great question. And I think, a lot of it has to do with US exceptionalism. US growth has been incredibly resilient, particularly relative to the rest of the world. And the US has now delivered 9 quarters of positive growth consecutively, which is amazing, particularly when we were worried about the most anticipated recession in history that just never happened. And that's because we haven't had a credit cycle. And if you look in the US, the consumer's really strong and the labor market's softening, but it's been resilient. And that's helped provide a very strong base for companies to do well. And I think the other facet is around a narrow cohort of stocks, the Mag 7 stocks you've probably heard about, including companies like Apple, Amazon, Meta, and the likes of Nvidia, that have dominated performance not only in the US, but globally. And the reason they've done so well is these are some of the most cash generative companies that we've ever seen in history. They have incredibly strong fundamentals, and they've been able to grow their earnings probably at about 47% this year alone, compared to the rest of the market, the 493 as we call it, at around 2.4%. And not only have they got phenomenal earnings, they're also benefiting from the mega trends of things like artificial intelligence. And they've been spending, almost $200 billion on CapEx this year as they build out in that race to win. So I think that's been a big driver of the returns that we've seen over the last few years.
And do you think the scope, as those companies continue to perform really well, that the rest of the market might catch up? So perhaps smaller companies, companies in more value-orientated sectors, or will we see those magnificent 7 names continue to dominate returns?
I think they'll still be long-term secular winners. I think just when we look at how strong their cash flows are and their earnings potential, but I don't think they can grow at the same pace that they have this year. And I think what we started to see in July was a broadening in the market. To your point, we started to see value companies come back, particularly areas like energy and financials. And small caps is an area that we like, particularly on valuations. And they've rallied quite significantly, but we still think they look very attractive, particularly in the US. If you get tax cuts and deregulation, that is good for small caps.
And that brings me on quite neatly to geopolitics and the question of President Trump returning. It's something that certainly has been a big topic of discussion in the investment community. How should investors think about these geopolitical issues at the moment?
Yeah, there's a lot of uncertainty, right, with geopolitics, but I think we had a decisive win for President Trump and the Republicans with a red sweep. That gives them a stronger mandate. So on one side, we have a bit more definity. On the other side, there's a lot of policy fog. We don't know what's going to turn from campaign pledges to actually policy implementation. And if I could see, what we've seen in the markets is the Trump trade. We've seen stocks going up and bond yields have moved higher. But I think what we really need to focus on is his policy focus. And there's a few areas, right? So first is tax cuts and deregulation. He's talked a lot about make America great again. And I think this will help growth in the US, but it also helps areas like companies in terms of corporate margins and small caps, to your point. On the other side, you've got tariffs and tighter immigration, right? And tariffs, he's talked about more recently, 60% on China or 10% more recently, and a 10% universal tariff. So this we could see as an impact on inflation in terms of a one-time price shock. But of course, if he has tighter immigration, that could be a structural hit to labor supply. And that again could be inflationary. So we need to see what this pans out in the new year. And then finally, I'd say fiscal deficits is another risk for markets. So in the US, the fiscal deficit is 7% of GDP. That's the size of the whole Australian economy, right? So this is big. And just 2% is spent on the interest costs to service debt. That's higher than what they're spending on national defense. So this is a big number. And it's not just the US that faces fiscal deficits. We're seeing it across the world. Why does this matter for investors? It means governments need to issue a ton of bonds. When you increase supply, that means bond yields start going up because prices are coming down. And so that has implications not only for fixed income investors, but equity markets, particularly when you think about expensive valuations today.
So it sounds like some risks and some opportunities then from President Trump. It's not long now for us to wait and see how it all pans out.
Yeah, and I'd have some defensiveness in portfolios. To your point of view, I think US exceptionalism continues, but there is volatility in markets, which is not always risk. It can create opportunity, but adding some defensiveness in the portfolio seems to be prudent.
We hope you've enjoyed watching. If you have got any questions about anything you've heard today, get in touch with the team at Asset Intelligence and we'll be happy to provide you with further information.